Hi everyone, welcome to Bond Bytes, the daily bond market highlights from INR bonds. I'm Arjun Patsati, and in today's market, the whole news is all about margins, margins, and margins. And before we go into margins and how it's affecting equity markets and also the bond market, we would like to announce the launch of our app, Quick Invest by INR Bonds, where investors can download the app in Android or iOS and invest in bonds in just a few uh, clicks of the screen. As usual, INR Bond showcases a list of bonds, curated list of bonds with the most information and also the easiest of investment processes. Download the app now. The link in the description will take you to the app downloads. Uh, Coming back to margin pressures, we had today in the market the 10-year government bond slightly down, but still at a much higher level, 6.60%, which is close to two-year two-year plus highs. And the Sensex Nifty fell sharply on more and more corporates, resulting very sharp falls in margins as high raw material costs are hurting their ability, and even they're not able to pass it on to the end user, and most of them are desperately trying to pass it on to the end user. So the raw material prices are hurting producers very sharply, and it's being very felt to a very large extent in the third quarter. And the guidance is that most of the corporates will continue to face heavy margin pressures. And with the commodity prices rising again starting this year on supply shortages and including energy prices, including other commodities and many other commodities, then there's no respite for producers who are looking to offset large falls in margins. And so this is clearly hurting the markets. And clear. And also the fact that the this is hurting the bond markets as well because margins, high commodity prices indicate very high inflationary pressures. And while RBI has largely been showing a benign face on inflation, the fact that they are allowing bond yields to rise without intervening too much is showing that that concerns on inflation is coming up. And also the fact that the Fed is also now moving very fast towards containing a structural inflation overhang in the US. And while inflation is to some extent is good for the economy, a very high inflation over long periods of time can derail an economic growth and bring it down sharply to and which can hurt the economy very badly for longer periods of time. So with all this, margin pressures are hurting bonds and equities. Bond yields have risen and equities are showing high volatility, falling and rising very sharply up and down. Investors are getting a bit unnerved, and in this, there are very few bonds that are offering some solace. And clearly, it's a matter of selection of what bonds to invest in to protect the portfolios as well as earn some returns that are higher than inflation. And in other corporate bond news, Air India, which is being taken over by the Tatas, they are looking to prematurely close out two large two bonds that they have issued with 100% guarantee by the government of India. These amount to rupees 55 billion or 5,500 crores. And though this time the government is looking to compensate the company is looking to compensate the investors, because if investors have invested in a bond with 15-20 year maturity and suddenly they find that it's being prematurely closed in 10 years, then paying face value means a huge loss of capital for the investors. But here the government is paying market levels for the buyback, and looks to be and uh, because they need to close out that guarantee before Tata's take over the Air India. So investors, to a very large extent, are compensated for the fact that of the premature closing, but still, given that they have been issued at very high coupon rates, that means they still tend to lose out that higher interest rate they were getting on these bonds for the next 5 to 10 years, which is not a good sign. So it's both good and bad, but mostly bad for investors who have invested with long-term investment, especially retirement funds, who depend on very larger interest income to service their provident funds, uh, service their provident fund investors, and so this can hurt the investors as well. So thank you very much for listening in, and do not forget to subscribe to our YouTube channel if you've not done so already.